Good. I can see more and more people joining. That's great. Just give them another second or two. Oh, I've already got the signal. That was even
Oh,
quicker
great.
than it is normally. So I guess it's over to you, Samantha, if you'd like to start.
Yeah. Hi, everyone. I'm delighted you could join us today. My name is Samantha Taylor, and I'm an analyst at IFI Global. Welcome to our podcast and webinar on the Guide to Europe, Part 1. This is a two-part guide we are doing primarily for US-based GPs and other third-party managers who are interested in developing their business in Europe.
Samantha, you're freezing.
Today, we'll be providing. Oh, no.
Carry on. Let's see what. Hopefully, you will unfreeze. We'll just carry on.
Okay. Today, we'll be providing a macro overview, which is tailored to things that should be thinking about if they are coming to Europe. We'll also touch upon allocation trends, potential partners for third country GPs, such as service providers and mancos, and finally, domiciles where managers may consider putting their funds. In part two, we will cover distribution options, regulation, fund structuring, and more details on investor trends. If you would like to ask a question, please do use the Q&A button at the bottom of your. I will now.
Hi. I hope everyone got the gist of that. I think Samantha's got, hopefully just Samantha rather than me as well, has got a slight communication problem. But anyway, thank you all very much for joining us today. We're absolutely delighted to see the attendees that we have from not just the US, but also from various other countries as well. As Samantha says, we are going to very much allow time for questions. We actually put on the invitation for this, as you may have seen, for people to send in thoughts or questions they'd want us to raise in this session. So we have a couple of people who have given us something on that, which we'll get to later on. My name is Simon Osborne. For those of you who don't know IFI Global, we are a research and a media house based in the City of London. We have 3 monthly publications, one weekly, but we are first and foremost a research house. We do more work on the research side than on media side. And yeah, I guess under our research part of the business, we're in the process of publishing a guide to Europe that we're going to be sending out to all the GPs we know, not only in the US, but in many other parts of the world too, we believe have an interest in Europe. We've been covering this stuff for, I was going to say years, but it's probably more like decades now than years. What's new, however, is that we have just very recently launched an advisory service for GPs covering any aspect of their potential development in Europe. And at the same time, we've also launched an intelligence service which it helps people on allocations in the private market space and in a couple of very specific areas in that particular part of the business. I will touch on that a little bit later. But let's get on with the main areas covered in part one of our guide to Europe. I think one of the things that often gets missed when people talk about what's happening in Europe are the macro issues, and particularly for those of you, and I know several of you joining us, or many more than several in the US, it's probably a good idea to spend a second just giving you a little bit of background on what is happening over here in the European region. There's been over the last 20, 30 years such a huge surge of investment into both private and public markets in the US, as I'm sure we are all very well aware. But just to put some figures on it, it's quite extraordinary. US equities market cap is now about $55 trillion. It's now getting on for nearly half the global total. Back in 1998, before the millennium, it was down at 13 trillion. And what I find really quite remarkable is the ratio to US GDP now of US equities overall is over 200%. It averages over the last 20 years 140%. The obvious reason for this is not just Americans, but of course people from Europe and indeed the Asia Pacific region, but significantly part of that are Europeans are allocating more and more to the US, which has done economically infinitely better than the rest of the world. It's certainly the region that I'm in at the moment, i.e. Europe. And we're using here public markets. The figures obviously are much more difficult to get on the private market side, but we're using public market figures, which are obviously easy to get to make this point. But there's been just as much growth from the rest of the world, especially from Europe, into private markets, private market managers in the US over the same period of time. I just picked out something for today's presentation purposes, just looking at the last 3 years, which have not been particularly good. If you look at private equity and the other illiquid private market strategies, not bad, but not good after the surge in the years before 2021. Still, the growth has been 14% over that period. Another couple of points to make on the macro issues that may be of interest to you is, if you don't know Europe that well, that is the strength, if that's the right way of putting it, or the depth, probably is a better way of putting it, of the structural problems that European countries have at the moment. It's not something that I don't think, gets discussed enough. For example, unfunded pension liabilities in pretty much all European EU countries, I should say, vary between 300 and 500% of GDP. And according to the Financial Times, Europe is the only region of the world which has or will have a falling working age population over the next decade. And we don't have in this part of the world anything like the amount of innovation that you have in the US. There's a lot of people, I really want to emphasize this point, it's quite important. There's a lot of people it's a very wealthy area, Europe still is, but those of us who have assets are increasingly coming around to the views, it's institutional, professional, but indeed even retail, coming around to the view that it's going to be better off for them to allocate more and more of their portfolios to not just the US, but obviously the US, but other parts of the world as well. Something I want to raise, this is a very new and recent point that's been occurring to me. We had something in our weekly this morning about whether the US dollar plunge could turn into a rout. As you will doubtless know, US dollar has declined over the course of the year by just over 10% on the basket of other currencies. If that is the situation later this year, if the dollar continues to decline or that decline accelerates, those of you who are considering developing your business in Europe might want to consider putting your investment offering, whether it's a share class or something else, into euros, because it's, as I say, at least possible that we are in a period where the US dollar is going to continue to decline significantly over the course of the year. There's now talk, as I'm sure everyone is aware, that the US dollar will no longer be, in the medium term at least, the world's reserve currency, and a basket of currencies, indeed perhaps Bitcoin amongst other things, will come on and take its place. So if that is something that you think is potentially going to happen, you don't want to be a European investor allocating into dollars and seeing your dollar holdings decline in euro terms by 25 or 30% from maybe where we are today. Last point on the macro, which isn't really macro point, but I need to put this in somewhere, so I put it in here. It really is worth emphasizing that it is, by comparison with almost anywhere else in the world, even perhaps to a certain extent the States, it is relatively easy for US managers to access US GPs or any GP to access European professional investors. There are a number of different ways of doing that. It is possible to get in, despite the image that Europe has as being Fortress Europe, keeping the outsiders at bay. There are many, many, many investment managers from all over the world, especially the US, but from Australia, the Asia Pacific, and of course now here in the UK, we're outside the EU as well, who are plying their trade across the European region as a whole. Moving on to LP allocation trends. This is data we work with a firm called AIRaise, which is in London and San Francisco. This is data we got from them much earlier in the year. And I did look, this is global. This is a survey they did for us a good few months ago. The European figures aren't very different from the figures from the rest of the world. So this is in what they've come up with their 5 biggest categories of where investment LP allocations are going into the illiquid alternative asset classes. The only perhaps slight surprise is how big venture capital is, and that was quite a surprise. Other than that, nothing that probably you wouldn't expect to see. I want to make and one of the things they did talk about in the report, but in comparison with these 5 asset classes that were smaller, is the growth in this part of the world, which is really important to emphasize, in sustainability. They're all at IFI Global. We have a publication called Sustainable Investment Intelligence, which covers all the sustainable sectors. There's one in particular, they're all growing, and they're all growing quite significantly, but there's one in particular that's growing very substantially indeed, and that was picked up by AIRaise, and it's been picked up by many, many others as well as ourselves, and that is renewables. Quite remarkable things are happening in renewables. First of all, we quoted 2 surveys which were done late last year by McKinsey, the consultants, and Natixis, the asset manager. Very large samples both those surveys had. It does show in both cases that LPs are going to continue to allocate more of their overall assets to the private markets, including here, of course, in Europe. Natixis, or Natixis, however you pronounce it, the thing that really stuck out for me, I found fascinating in their survey, which was with 500 institutional investors, as I say, many of which were in this part of the world, 35%, which is by far the biggest sample, said that they are going to be increasing their investment into renewables. And Samantha, with me today, has just finished doing research which we published in June's issue of Sustainable Investment Intelligence. We're doing this all the time. We've done this for the last few years, but we've just done a global overview of pension funds. And Samantha, how many pension funds did you survey for this time around?
It was 70 across 24 countries. They have a combined total assets under management of well over 10 trillion. Throughout 100% of pension funds within our index allocate to renewable energy. And as you can see on the screen, 68% within the last 12 months have increased their existing allocation into renewable energy.
That is the most remarkable thing. I mean, we also go into individual geographical markets and into segments into the sovereign wealth funds and indeed the family offices as well as the pension funds. We slice it and dice it in all those different ways, geographically and by investor segment. And in all of them, they are all allocating over, correct me if I'm wrong here, Samantha, over 90% into renewables
Yes.
already. But Samantha's just said what's remarkable is they're already there, but they're also increasing their allocations in the sector on top of what they're already doing.
Mhm.
Right, so let's get off allocations and move on to other areas. We've at IFI Global, I should say, have had for a long, long, long time a particular interest in European or global, it's not just European, global fund governance. It's something we have been tracking all the way back. I think we launched the NED long before Samantha joined us back in about 2010 or so, in the wake of the drama surrounding the market crash of 2008, Bernie Madoff, etc., and all the dramas, Weavering, and all the other stuff that was going on back then. And fund governance, probably or partly because of all the bad things that happened in the wake of that market crash, is now taken very seriously. And I do want to emphasize to anybody from the States, it's very different over here. So some of and this doesn't get covered enough in presentations of what goes on in Europe. If you're coming, which I think most of the people on following us today are from the private market side of the business, and you coming from the partnership side of the business, you really won't have come across the kind of governance arrangements that we have over here before. Some of you, or many of you indeed, may have done that through your Cayman funds, where, with all due respect to Cayman, I don't, please, I'll deny this, saying this if anyone from Cayman is listening, is not generally often taken that seriously in comparison with governance standards in Europe. But when we talk to, and we know many of the fund directors in Cayman, they try and educate US GPs on the importance of governance for the first time. Some of them are more successful in that task than others. But when you get to Europe, it's a whole nother level of seriousness. And that is something that is worth emphasizing if you're thinking of coming here, that you need to start thinking about how you will, your governance arrangements. And this brings me on to the role of what's called a ManCo, which is abbreviation for management company. Often these days on the alternative side of the business, people use the term AIFM, meaning a third party AIFM, which is just a manager of an AIF, which is an alternative investment fund. This is all lingo that came out of the AIFM directive, which goes back to 2011 or 2013, depending on which year you think it started. It's now well established, that whole way of looking at the alternative space. If you're coming to Europe and thinking about domiciling your fund inside the European Union, which is going to be almost certainly Luxembourg or Ireland, you're going to have to get familiar with all of this stuff here. And risk management, and this is very, very important, and again, not spoken enough about by many people who are presenting what's going on in Europe, is functionally and hierarchically completely separate from the portfolio management. So if you're based in Chicago or Boston or New York or San Francisco, or indeed now even in London, you have to have the risk management done in the jurisdiction where your fund is domiciled, i.e. in Ireland or Luxembourg. That really is important. It's taken very seriously indeed. The CSSF in Ireland, or the CSSF in Luxembourg, or the CBI in Ireland can turn up at short notice and ask to see what you're doing on that, and they take it very seriously. It's their way of getting control of what's going on, because the portfolio management's been done outside their jurisdiction, and they want some form of control on it. That's a large part of the reason why it is done that way. And that is well worthwhile emphasizing. The ManCo can do that, and that's a large part of what the ManCo will do for you. It will do a whole host of other things in the looking after the oversight of the fund. And it's worth mentioning, because of this control thing and this not paranoia is the wrong word, but this desire, strong desire that the EU in Brussels and then the regulators in Dublin and Luxembourg to have control over the process. The last thing they want is a fund blowing up in a regulated jurisdiction and having no control over what's happening, because the investment manager is on the other side of the world and maybe goes and does a runner or something, and they can't get hold of them. They want people that they can hold their feet to the fire. And actually, I mentioned Madoff in another context a second ago, just this month, just earlier on this month, the long remnants of that catastrophe, there was another payout for a Luxembourg entity that was investing in Madoff just in the last few weeks. So it's something, and that's actually part of the reason why we got the AIFM directive in the first place. It's something that the regulators take very seriously indeed. The other thing, and I've half mentioned this already, is the fund board. And I would say to, and I do say this a lot to managers that don't take the composition of their fund board that seriously. They may have got a fund domiciled in Cayman, where they have 2 or 3 people on the board to anchor it into the local jurisdiction and all its regulatory requirements. But I think they should think of the fund board as their friend, something they can use to help them with. It really doesn't cost a manager much more to have a good board as opposed to a bad board, certainly a board that's inadequate in many ways. It really doesn't. And you may as well, therefore, try and get some good people to be on the board and use them as de facto part-time employees who can open doors for you, that can help you. They're on the same team as you. And that is something that I really do think is worth emphasizing. We've been publishing the NED, our fund governance publication, as I say, since 2010. We've seen a lot of changes in that business. And I would say right now, with the growth, I've already mentioned the growth of renewables, but the growth of sustainable investing, and now the growth of digital investing, having a good board in those areas is really important. It's perhaps less important in some of the more bread and butter routine areas of the market, and they're very easy to find fund directors for those boards. But if you're doing something innovative, new, having capable, good people on your board as part of your team really is something that, and I can't emphasize enough. And as I say, it really doesn't cost any more than having a poor board. And we see such a wide variety of boards between the good, bad, and the indifferent. Next point. So we're coming on to the selection of partners. We're going to do more on this side of the discussion in part 2 of this. I wanted to say to those, and I know there's one or two Mancos joining us today, maybe even more than one or two. The list on the left here, starting with Apex going down to JTC, these are Mancos or third-party AFIMs that share with us or give us, or they did for our last Manco guide. We publish a Manco guide once a year. We've been doing it for 9 years, and those firms on the left provide their AUM and number of funds for that. We're going to be updating that more regularly in future, so it won't just be once a year. Those on the right, we still follow, and we are very keen. I think there may be one or two people from those firms on the right joining us today as well. Please do share your information. We'd love to get your AUM and number of funds as well. And we're going to be listing all the Mancos in our guide, and we're going to, whether you are a subscriber or not, and we will, for those who ask us, we will provide the information that we have. We won't publish the information we have in the guide because it'll be pages upon pages of that, but we will provide that on a tailored basis to our subscribers who want that information. And of course, that gives us an opportunity to update it on a fairly regular basis too. Moving on from the subject of Mancos. Oh, sorry, before I move on, there's going to be pages on what they are, what they do, particularly explained for the US market in the guide that we are publishing very soon. So moving on to fund domiciliation, this has been in the past quite a controversial area, or can be quite a controversial area. And we put some estimates out in some cases in the Caribbean and Bermuda in terms of their total assets. It's very difficult to get those figures there from that part of the world. But there you have it. The two big ones in the EU are obviously Ireland and Luxembourg, both very, very, very well established, been around for an awfully long time, tried and trusted. And if you are going to be going after very traditional pension fund institutional assets, if you're in the big league and that's where you're going, increasingly, whether you're only looking at 3 or 4 markets or 1 or 2 markets or more, you may want to consider putting your best foot forward and paying what you have to pay and domiciling those funds in the EU, and then you will pass all the tests you need to with your potential investors if you do that. Now, if you're not doing that, if you're not necessarily going after AP7 in Stockholm or some major Dutch pension fund in the Netherlands, if you're potentially going after more the family office market, and we know a lot of managers who are in that extreme high net worth market, family office market, private banking part of the world, including, of course, Switzerland. By the way, Switzerland and the UK are not in the EU anyway, and they are two of the largest investment markets in the European region. So if you're going after more the high net worth private banking family office market, you do not necessarily need to domicile in the EU, and you can use different mechanisms. We'll get into distribution in much more detail next time round, but you can also look at Guernsey and Jersey, for example. And also, if you're an institutional manager who's going after institutional money, you can use Guernsey and Jersey very successfully, and many do, for private placement, which is definitely worth looking at. And many Dutch pension funds and the Nordic region, the UK, those markets are still very private placements, very, very, very common and a tried and trusted route. You don't again need necessarily to go to Ireland and Luxembourg for that. It really the long and short of fund domiciliation is every fund, every manager, every investor situation is different. There is no right or wrong answer. It really depends what part of the market you're in and what your ambitions are and where do you think you'll be going in the next year or two. And we have a lot of information on all the jurisdictions that are on the screen, and we can tell you war stories till the cows come home on what happens in those various jurisdictions and the advantages and disadvantages perhaps of being in one over another. Right. Before we get in, as I say, we really do hope to get some questions. I know one or two people have already given us some before we got here, and hopefully we'll get some more from this session as well. I just want to mention what is in part two of the guide, and that I've already mentioned. We're going to have a lot more on fund and investment structuring than we haven't really touched on that today. And what is happening, not just in Europe, everywhere in the world, but very much including Europe, is there's innovation in investment structuring going on. The old tried and trusted way of doing things isn't necessarily going to be the way that investors want to do things in the future. Distribution, we're going to get into all the different types of distribution that are available. That will be a big part of the second part of this. And with that, the obvious complementary part are the regulations that go along with that. And there was a distribution directive just a couple of years ago in the EU anyway. And then, of course, it makes sense to get into onto the lawyers and the service providers that were doing the non-Manco type service providers. And I should have said when I was going through the Manco part of this that a lot, if not all of those, also offer fund administration and other forms of service provision, as well as the Manco AIFM hosting service as well. So I think I may have one more slide before we go to questions. Yes, I wanted to mention, as I said at the very beginning, we've been covering all this stuff for decades, not years, but decades. What is new, though, is we are now offering an advisory service, which we're doing with a firm in the States called ASC Advisors, and we advise managers, GPs, on all those areas listed down there on the left. And then we also have developed separately, which we're doing by ourselves, and what we're calling an intelligence service, where we've gathered, particularly in our sustainable side, a lot of LP allocation information, and that's one area of particular specialization. That's a large part of what Samantha does, and sustainable investment development overall is an area of particular interest since we published Sustainable Investment Intelligence. And just recently, we've been developing strong interest in tokenization in private markets. We're not looking at money market funds or the retail type stuff, which is where a lot of the tokenization is taking place. We're talking about the tokenization of what's happening in private markets, and our publication, Alternative Investment Strategies, has for the first time, just in the last few days, published its June issue with lists of funds in all the liquid alternative asset classes that have tokenized options. Samantha, can you remember how many we had of that in AIS overall? It's about 70 or 80 funds, was it, in different strategies?
I think it was about 76. Yeah, 76.
Yeah, 76 was it? Okay. When we hope, and that's in all the different sustainable and alternative private market areas. And we very much hope and expect over the course of the next year or two. If it is 76 today, it will grow and grow in the future. And by the way, now both the advisory service and the intelligence service, if you are a subscriber to any of our publications at a corporate subscription rate, you are able to ask us any questions in any of those areas for as long as your subscription is in place. It's part of the subscription service. So at this point, I'm going to stop sharing screen. And as I say, I know there's two areas we have questions on. Maybe we've got other questions as well. So
Yeah.
shall we go to the two we know we've already got? And then I see
Yes.
there's three at the bottom of the screen already. So maybe we'll get some more. But we promised we'd finish at 1:45, so we've got just under 15 minutes. Do you want to? What's the first one
Yeah.
we got before?
Someone has asked whether we could discuss third-party Manco and AFIM fees.
Yeah, okay, fees. Yes, they vary a lot. They vary perhaps less than they used to, and I think it's historical. It's because in the old days, the a lot of the firms that got into Manco hosting, some of them came from administration, and they did it as to get to the administration, and therefore they discounted the Manco hosting in order to get to the administration because that's what they really wanted. And indeed, the same applied to at least two of the very largest in the business now on the governance side, who came from offering fund governance as a service, and they then got into hosting that way as well. So it's historical. They were prepared perhaps to discount in certain areas on the Manco or AFIM hosting to get the business in other areas. And something I should have said perhaps as I was doing my ramble through is when we've done research, we haven't done it very recently, we've done it, I think, the last time about a year ago or more, is that most of the managers we talk to in the States, they do like going and having a one-stop shop service for Manco hosting, service provision, whether it be the regulatory work they need doing, and the directors and all sorts of other things too. And not all of them do. And if you've got the time and money, people will use different services. And some investors do prefer that. But if you're smaller, going to one entity that can provide you with all of that is quite compelling, particularly from a fee point of view. But they do vary, the fees. One thing I would also add is, and there are some, not many, but there are some who will do the fees on a fixed rate. Others typically do it for a certain percentage of the basis point fees of the assets and a basic fixed rate too. But there are some that do it just on a fixed rate, very few, but at least one or two that we know that do. The variation is less than it was, but it's still there.
Mhm. Okay, so the next question we have is it still possible to still use reverse solicitation?
This comes up a lot, and it came up just in something we did about a couple of months ago, a
Yeah.
lot. The answer is yes. That is, I think, something that we really should wait until, and we'll have a proper good old going on over on reverse solicitation when we get to part two of this. There was a scare when the EU passed its Pan-European Distribution Directive, which I think is maybe even 2 or 3 years ago, that it would bring an end to reverse solicitation. And there was, as I say, a very big scare that was going to happen, or they would tighten up on it. It doesn't appear to have happened. There's been all sorts of scares over the years. What I always tell people is it's not a distribution strategy, private placement. Lawyers will say it's not, and it isn't. However, if you do have a really good lawyer, they can probably protect you from the downside of an angry investor if they lose money. Because if an investor comes in through reverse solicitation and they lose money, if it is reverse solicitation, they can potentially claim to get their money back. But a good lawyer should be able to prevent that happening. And for those who say don't use reverse solicitation, I always say, give me one example that we know of where a manager has been caught out and has been hauled through the legal process and found themselves in real trouble. I've been following this subject for decades. I've heard lots of rumors over the years, stuff probably has been swept under the carpet on a number of occasions, but there really hasn't been any big dramas. It's not a long-term solution. If you're putting your toe in the water to come over to Europe, then yes, and you have a good law firm with you, then yes, it's probably you can use reverse solicitation. If you're planning to hang around and develop your business, do not rely upon it in anything other than the short term. So those are the two
Okay.
questions we knew we were going to get, and I see we got three more down here. Do you want to read them out?
Yeah. So someone has asked, is there a particular investor segment that is expanding into renewables, or is it all categories?
You, Samantha, would be probably better to answer that question than me, perhaps, since you've been doing all the work on this. But am I right in saying it's across the board in family offices and in
Yeah.
uh, sovereign wealth funds and pension funds?
Yeah, I think pension funds, I think 100% across the board within our environmental investment monitor allocate to renewables in some way. Family offices, I believe it's slightly down to about 90%. It's still very, very high. Sovereign wealth funds, again, it's almost 100%. So there's strong interest in renewables within institutional investors.
Yeah. And I would add to that that again from you that we're seeing a big growth in biodiversity investing, although we have a category which is not it's nature, biodiversity, and regenerative agriculture. That's growing quite quickly as well at the moment, isn't it?
Yes, within the pension funds, I believe that was the second highest increase within the last 12 months for allocations. I think it was again 28%. So it was the highest, second highest, behind renewable energy.
Right. All right. If I was a betting man, I would say that's going to keep growing quite quickly in
Mm,
the foreseeable future. Um,
hmm.
so next question, shall I read it out
Uh,
or you read it
okay.
out?
How much would it help us to domicile funds in Ireland or Luxembourg with European professional investors?
Uh, it, I hate this is like a politician's answer. It depends on who your professional investors are. If they are the really large public pension funds, um, then it probably does help because you really want to make sure that you are ticking all the boxes that they will have many boxes to tick that you need to go through with them. But if your professional investors are in other categories, for want of a better term, then I don't think it necessarily makes a huge difference. I mentioned when we were talking about domiciliation that I do think private placement is a really good option, and even for large, I shouldn't say specifically ABP or PGGM, but certainly some of the large Dutch pension funds are very comfortable using private placement, and you don't need to be domiciled in the EU to do that. And that's one of the reasons why managers or go to Guernsey and Jersey, for example, for to take that particular route into the European market.
Mhm. So our final question is, what LP allocation information do you have?
Well, we almost already mentioned that, probably. What we have a lot of data on the allocators, and we'd also give examples of not just the numbers, we give examples of the schemes people are investing in. When I say people, professional investors are investing in, whether they be pension funds, sovereign wealth funds, family offices, etc., what they're doing, particularly in sustainability in all the sustainable sectors. And we're now developing that in terms of the tokenization. We have the numbers too, but it's more than the numbers. It's the examples of the individual schemes. That's the kind of information that we are giving to our clients in those areas. Am I missing something, or is there anything else we can give rather than that? That's probably
I don't, I think that's quite comprehensive.
yeah. Well, we are, by luck, more than design, we're almost coming to the end of our allocated 45 minutes and we've answered all the questions we've got. So I guess we should say goodbye to everyone. Thank you very much for joining us. I'm delighted you can make it, and hopefully see you for part two. We haven't got the date of that yet. We'll obviously be announcing it whenever we do. And then the all of the stuff we've covered today and in part two will be covered in a lot more detail in the guide, and there are articles on this monthly in our publication, Alternative Investment Strategies. So thank you again for joining us, and hopefully see you the next time. Bye bye,
Bye.
everyone.